It is with great pleasure that I introduce our keynote speaker, Professor Larry Christiano. His academic contributions are so well known that I don't need to list them. They speak for themselves. Instead, I would like to highlight an additional element that makes Larry Christiano fit so well into our conference. That is called Bridging Science and Practice. Is Larry's dedication to teaching and passing on his knowledge to many courts or central banks economists. And every time I visit a policy institution or a central bank, I seem to meet someone who proudly says, I learned a lot from Larry Christiano. And I'm for sure one of those. So thank you for everything you have taught me and so many others. And today, Professor Christiano will share his insights on the transmission of US monetary policy. And without further ado, please join me in giving a warm welcome to Professor Larry Christiano.
Well, it's a pleasure to be here, and I'm very moved actually by what Roberto said. Roberto and Massimo and I spent a number of years working together, and they're very, very important years for me. And somehow the words you used made me, now I've forgot my talk, and I'm anyway, so there's a weird title up there. I hate titles like that. But however, the title has the whole talk in it. You could actually leave after I say it. The title is a play on a paper by 3 ECB people here. Luca Dodola is, I don't see him. But anyway, it's a play on their paper, a title, where they say when the Fed sneezes, who catches the cold? And they answered the question as, well, when the Fed sneezes, everybody catches a cold. Almost everybody catches a cold. So this paper says, what we do is we investigate how everyone else catches the cold. And we come up with a result that's, I think, very shocking, and it's completely different than the literature, and some of you may become enraged when you see it. It seems to be that the way the cold, when the Fed sneezes, the way the cold goes through to the rest of the world, the mechanism through which it goes is through imports, and particular not through financial markets. This is the enraging part, because most of the literature today focuses on the mechanism through the financial markets. I will include financial markets here in a big way, with all the bells and whistles, every possible thing you can imagine. But in any case, we're saying it goes through the import channel, U.S. import channel to the rest of the world. Sorry, I should say I have co-authors. I usually tend to not forget about that. But then Santiago, Camara, and Husnu, who is right here, are co-authors on this work. Part of this this is in the macro annual, and I'm also going to be showing continuing work on this. So background. The work on the dynamic effects of U.S. monetary policy shocks has had a major impact on the design and construction of economic models, closed economic models. And in recent years, this work has really accelerated as we start measuring monetary shocks more closely. It's the one shock that we can really measure. Actually, there's also the shocks that were just discussed, the Diego shocks, are another example of shocks that we can really kind of measure and think about. So the high frequency stuff has been very important. And however, most of it studies the impact on the United States. More recently, that work has been expanded to ask the question, how does the US and the world economy respond to this shock? And that's where the Dodola, this paper that was written here, if the Fed sneezes, who catches a cold, was written, and our paper is going beyond that and saying how they catch the cold. So the best way to start thinking about this stuff is to think about the classic Mundell-Fleming view about things, which is that when the U.S. raises interest rates, that makes U.S. more attractive, so people reallocate to the U.S. In the process, that of course makes the dollar appreciate, and then spending shifts from the United States to the rest of the world, and boom, the rest of the world booms, and no cold there. And there's an emerging consensus, which is that that's all wrong. When U.S. tightening makes the rest of the world actually contract. The conventional interpretation, as I have just been saying, is that the monetary shocks are transmitted primarily through financial markets. And another theme of this paper, which is very much counter to the Ariel Rubinstein approach that I was describing yesterday, the theme of this research, which I thoroughly agree with, is that the world is complicated and it's got all kinds of frictions and crazy stuff in it. And I will have frictions and crazy stuff too, although I'm going to disguise it from you because of time constraints here. So I agree with the associated frictions, but we are going to reach a different conclusion, which is that with all the frictions, we're going to find that monetary policy shocks transmit primarily by triggering a reduction in U.S. imports. Our findings, now, I'm basically going to be repeating the title over and over again. So if that's what you think I'm doing, actually, yeah, that is what I'm doing. So the U.S. contraction caused by U.S. policy tightening leads to a large decline in U.S. imports. Financial frictions play an important, but we are not saying don't do financial frictions. They play an important role in how the foreign economy responds when U.S. imports go down. So we are embracing fully financial frictions, balance sheets, that whole thing. The large decline in U.S. demand for imports leads to a decline in foreign exports. And the main reasons, that is the main reason why those foreign guys contract. There is a feature that people don't emphasize, which is that when U.S. raises interest rates, the foreign guys reduce their exports by a huge amount. If you let that sink in for a minute, you realize, what? What? Okay. Well, I'll tell you the answer. It's U.S. import demand that's going down. Okay, so the decline, we also find the decline, and this I think is very informative for certain things we may get into. The decline in emerging markets after the U.S. sneezes, raises the interest rate, decline in emerging markets is substantially larger than the decline in advanced economies. In fact, the decline in advanced economies is sort of, might even not, the point estimate is that there's a decline, but it may not even be significant. What we do is we attribute to this in our model to a greater exposure by firms to dollar debts in emerging markets. That is, you can borrow more in your own currency if you're an advanced economy, but in the emerging markets, you often end up borrowing in dollars for a variety of reasons. And we're going to reach these conclusions by looking at a lot of impulse responses, and then, I have to do counterfactual simulations in order to figure out what is the role of the financial markets versus the imports. So I'm going to have to construct EME and AE, small open economy models, that match our IRFs. And then we'll do counterfactual simulations. The data I'm going to use is 2006 to 2019. The reason for that is, well, a couple of reasons. One is, in the case of emerging markets, we would lose a bunch if we used data earlier. Second, I'm 100% confident that the world of the emerging markets is very different in the 2000s than it is in the before the 2000s. Regulatory changes are substantial, and so I'm not sure I would have wanted to go earlier, even if we had the data earlier. The monetary shocks we're going to use, I'm going to just show you one thing that we do. We do everything, like the Jarochinsky and karate stuff, we do that as well. We do all kinds of different things, but the headline presentation I'm going to give you is based on Bauer and Swanson estimates of monetary policy shocks. I'm going to start with a US VAR. It's going to have all the standard kind of data in there, except one thing. Nobody in the US, everyone in the US thinks the US is a closed economy, and there aren't any other economies. And so the exception is that we're going to include exports and imports in the model. I'm also going to include an interest rate, R star, which is the U.S. interest rate, will always be the U.S. interest rate. And R star is, it's a risk-adjusted interest rate. We could spend days talking about this, so I'm going to cut it down to no time. But anyway, we use something from Gilchrist and Zakrajcek to construct that thing. Here are the U.S. impulse responses. They're basically the same as we used to estimate in the 1990s for the U.S. They don't seem to change. So you can see in the top left, the interest rate goes up. By the way, the scale is not pinned down here. So we know that the Bauer-Swanson, any of these indices of monetary policy are pinned down up to scale. So if you can't see the vertical axis, that's okay. The key thing is the shapes, and the key thing is the relationships between the shapes. That's the only thing that I'm going to be looking at. So interest rates go up. The dollar index, is confusing. Open economy is confusing because you never know whether appreciation goes up or down or whatever. And it gets even more complicated because if it's a dollar, that's a trade-weighted average in the US. Trade-weighted averages always go up, and that's when there's an appreciation. Normal exchange rates go down when there's an appreciation. Not my fault, that's the way it is. So anyway, we see an appreciation of the dollar, prices go down, GDP goes down, consumption goes down, investment goes down, exports go down, imports go down a lot. I mean, they go down about the same as exports, but imports go down a lot. And this has been noticed before. This is nothing, actually these things are nothing new. People have accidentally included imports in their US VARs occasionally, and they get results like that. But I'm going to make a huge big deal out of it. So the thing I'm going to talk about is that, well, we get a contraction in the US, and the imports, the fact that imports decline, I'm now going to make a big deal out of that. There's another thing that I'm going to make a big deal out of is somebody asked me a particular question, which I'll come back to. So you might ask, well, what are these imports that go down? And the black line there is the decline in imports, which is huge. And then the other lines are the components of it. So imports are the sum of something. And so they're industrial supplies, auto parts, and capital goods. And what you can see is that, and we've ordered this by the most important one. So the dashed line is industrial supplies, the most important. So that's stuff that firms are using to do their production, and auto parts and capital goods. So I'm thinking about that this has a lot to do with probably the investment sector, which is contracting a lot. The imports are coming from that. Okay, so key results. here so far is that the interest rate rises, dollar currency appreciates, and then imports go down a lot. Again, it's been shown before, and don't worry about that last line. I will only use that in the event of a certain type of question I might get afterwards. So, so we're going to use, well, we use all kinds of methods, every local projections. We use different shocks and so on. What I'm going to show you is the results of panel VAR regressions, although I'm not going to show you the panel VARs. So we're going to do this to get all the impulse responses. So we verify robustness. I'm not going to show you that. The two sets of countries, advanced economies, I've got 10 advanced economies. They all kind of look like my model. Notice there's only one European economy because the European economies have fixed exchange rates against each other, and we don't want fixed exchange rates, so we pretend that Europe is actually Germany. The emerging market economies are these, and now we played around a lot. You know, we argued, oh, this one belongs here or doesn't belong here. We discover after a while, you take out an economy there, or you include it, they individually don't make much of a difference. The details are not that important. So this is how the advanced economies operate. Now I have the normal definition. So now you always have to ask yourself, who am I when I'm looking at this? So I want you to think of yourself as an advanced economy. So that an exchange rate depreciation means that, and I'm using normal exchange rates now. So an exchange rate depreciation means that your exchange rate goes up. So you can see in the top left, in the advanced economy, you get a rise in the exchange rate. The next thing shows that monetary policy responds to the rise in the exchange rate. I would like you to, in some sense, ignore that. We could get into a big debate. Oh, they're loosening monetary policy, and we can talk about all that kind of stuff. But the thing is, if you compare the movements on the vertical axis with the movements in the U.S., it's an order of magnitude. Oh, I shouldn't have done this. Okay. Those numbers there, those are all APR, I was going to say advanced something. These are annual percent returns. So the changes in the interest rate in the advanced economy, you can ignore it. I mean, they're significant, but they're literally an order of magnitude smaller than, so just think, US interest rates go up and these guys don't really respond very much. CPI is going down. GDP is going down, but not significantly. Investment, well, a little more. Exports, boom, that goes down a lot. Exports are going down a lot, and then imports go down the same amount. We're into FX interventions in this paper, so I should have deleted that. The AEs don't do much FX intervention. Okay, so the key things here are big depreciation, little small fall in GDP, a little bit of more serious on the investment. By the way, you get that, you don't need any frictions to get investment to go down because it's just a portfolio reallocation. If people want to hold more US assets, that means there's less funding available for domestic stuff, and so you do less domestic stuff. I can do that in a model with zero frictions of any kind. You would expect investment to go down, and maybe even GDP to go down. That's another flaw in the Mundell-Fleming model. Investment is called I without a time subscript, and it doesn't move. Okay, emerging market economies, okay, well, if you look at the top left, you see a depreciation. It's actually the same size as the depreciation in the advanced economies. Oh, now monetary policy is moving up. But actually, it's, again, order of magnitude. You can forget about those movements. They're very small. CPI is not very much. But now look at GDP. So now we get a fall in GDP that's but much bigger than the US. Now, that result is not 100% robust across our different methods. I mean, my takeaway after doing all the robustness checks is that GDP in the emerging markets definitely fall more than the advanced economies, and definitely fall an amount equal to the amount US falls, maybe more. So that's my takeaway. But anyway, there it is. Big drop in investment, big drop in exports. Those things are all robust. And of course, the big drop in exports, again, you know, if you stare at that for a while, you realize that's impossible. Or you think that can't be true. There's cognitive dissonance. When the US dollar appreciates, the foreign guys are supposed to increase their exports. And in fact, they go down. Oh, you might say, oh, well, we have dominant currency pricing. No. With dominant currency pricing, you simply expect exports to stay unchanged. The big thing that's going on here is exports are going down. Okay. So that's there. Our analysis, because it involves exchange rates and interest rates for all the countries and everything, it allows us to also characterize or do a characterization of uncovered interest parity. And so you may, you know, I'm going to show you a rejection of uncovered interest parity. Of course, the number of rejections is now almost unbounded. And I'm going to add something. I think I'm going to add a different perspective. It's much worse than you thought. The violation of uncovered interest parity. They're living in our impulse responses. So I'm doing this in the spirit of showing you my impulse responses. Plus, I'm going to give you a tiny peek at the kind of the frictions that we throw in there. We threw all of Hélène Ray's frictions are thrown in here. We maximize the chance that the interest rate that the financial markets are going to dominate in this game. We construct the model to make our conclusion that the import channel is important less and less likely, and yet it's going to dominate. Okay, so here's the uncovered interest rate parity, which says the interest rates everywhere have to be kind of the same after adjusting for risk. And that gives you, you can write this little expression. The exchange rate today is equal to the dollar premium plus the expected exchange rate tomorrow. And then you can unwind that. You can just keep going. I have to apply the law of iterated mathematical expectations. So I'm saying this is and that's living in the impulse responses. So I'm now showing you impulse responses. In the first period, that exchange rate thing up there, the delta there is the interest rate premium. It's the dollar interest rate minus, it is an apple minus an orange. I apologize for that. But the interest rate premium is going to be the dollar minus the domestic interest rate. And you get that equation. And then if you just keep on substituting, then what happens is you get now I'm making an assumption here, which is that the exchange rate in the distant future is going to zero. And now you might say, oh, of course that can't be true because the exchange rate's a random walk. So if the exchange rate changes, then my expectation in the infinite future is that, okay, and of course that's what we thought too, but then after we were staring at our VARs enough, we realized, wait a minute, and I didn't show you that when we did that, the exchange rates look like it's going back to zero. Now we didn't check, I only showed you 30 periods, so we go way, way out. And we find that the exchange rates in our VARs are going back to zero. That's not inconsistent with the exchange rate being a random walk, or looking like a random walk, by the way, because I don't think monetary policy shocks are the main shock in the whole world. So, but they appear to respond to a monetary shock by going back to zero, and the deltas go back to zero too. Now this is a VAR, these are impulse responses. So everybody goes in a geometric rate. you explode at a geometric rate, you go to zero at a geometric rate, which means that you're additively summable. In particular, that sum there is well defined in the, if that thing is going to zero, it's going to zero. Everything's going geometric in a difference VAR is a difference equation. And so we get now a theory of the exchange rate under UIP. And we have the deltas from our VAR. So we can calculate what would be the predicted change in the exchange rate if Dornbusch formulas under UIP worked. So what the prediction would be that the exchange rate would go, this is the overshooting thing. Eventually the exchange rate comes back and it goes up and then it comes down. Now let's look at what the actual exchange rate impulse response does. Boom! It's okay. So there's one familiar thing in here, which is that we get delayed over. You can see that you jump and then you keep jumping, but only for about 4 quarters or something like that. You keep jumping, and then but the key thing is because this thing goes up so high, in order to come back to zero, you have to have a slope much bigger than this slope here. So when it's coming down, there are really losses on holding dollars. In particular, there are 2 puzzles in exchange rate overshooting. I mean, I guess we can say it's delay. There's 2 parameters here to the problem. One would be is that there's a delayed overshooting. Okay, because there's delayed overshooting, it means you're making a return on the round trip through the exchange market, which means that the foreign interest rate is higher and the return on going around through the exchange market is also positive. So it's real puzzle. That's a puzzle. But there's another puzzle here, which is because it's going up so high, it has to come down at a very steep curve. People are losing money being in the United States. In particular, the 2 puzzles are, initially people are leaving money on the table by not going into dollars more. And eventually, after a few months, people are leaving money on the table by staying in the US. Okay, IRF facts. When the US raises rates, US import demand declines, rest of the world contracts. Contractions of foreign economy is larger in EMEs relative to AEs. And there's a similar drop in exports in EMEs and AEs. The similarity of that is going to be telling for me later. The uncovered interest parity is, okay, there's a surprisingly small amount of capital outflow from emerging markets and AEs when the US raises, in the immediate aftermath of the US raising interest rates. And then there is a surprisingly small capital outflow from the United States after that. There are 2 puzzles. And, 2 puzzles, so we have 2 frictions. One of them is just, the second one, let me start with the second one. The second one is that, now I'm using the language from the literature, there's reduced risk appetite. Okay, reduced risk appetite. I've wondered for a long time what that meant. It just means that people want to be in dollars for whatever reason. So in particular, people have an unnatural desire, unnatural meaning more than a pecuniary desire for dollars. So we put that into our model. We have an unnatural desire for dollars when the interest rate goes up. Okay, we're doing exactly what's done in the conventional literature about this stuff. But then the problem is they go up kind of slowly and they come down kind of slowly. Well, for me, an adjustment cost solves almost every problem. So we have an adjustment cost, and those 2 parameters, deliver the goods. I'm only mentioning this to you because we are incorporating all the frictions that are present in the existing literature in the financial markets. So we're giving the best possible chance to the financial markets being the channel. Okay, and then the way we model this stuff is there in those references. So, okay, so now we have to go to the foreign economies. I mean, we already went to the foreign economies, we did the VARs, but I'm going to build models of the foreign economies because I want to separate the the import channel from the interest rate channel, the financial market channel. So we're going to build open economies. We're going to get a representative advanced economy and a representative emerging market economy. And then the U.S., basically, we're not going to have any model of the U.S. where the U.S. is just a big VAR that spouts out shocks. We've got all kinds of balance sheet effects and various, we got the UIP frictions I just put in, all this stuff. I'm just putting these here so that you can feel a sense of gratefulness because I'm not going to show you any of that stuff. Okay, so the way we fit the model is by matching the way we fit the advanced economies and the emerging market economies is that we're going to kind of rig the parameters on those economies to try to get as close as possible to the impulse responses that we calculated. And I'm just going to show you the emerging market economies because I thought I would run out of time, but now I'm not sure I'm going to. But in any case, I've reproduced in that picture there the solid line that reproduces the VAR impulse responses to a monetary policy shocks. The emerging market economies, I think, are the most interesting anyway. But the emerging market economies, and so you can see well, I guess you're not supposed to say confidence intervals, these are probability intervals. So I've got the probability intervals and the point estimates there that I showed you before. And then the little dotted guys are from what happens when we feed the Bauer-Swanson shock to these economies. Now, the Bauer-Swanson shock has two effects. One is it makes the U.S. interest rate go up, and the other one is it makes the demand for the exports of these guys go down. And what we observe is, I guess we get a pseudo okay. I mean, so if we look at the exchange rate, that's the toughest thing because the exchange rate goes up so much. It's hard for us to get it, but we throw in a lot of non-pecuniary. They just love dollars, these people. So not only that, we have a delayed, that's our adjustment cost. We have a little bit of a delay, not very big delay, but we have a little delay there. You see the little dot? It goes up a little bit in the model, and then it comes down. Monetary policy basically does nothing, like in the data. Reserves has FX stuff. You can see the CPI is, it's a big struggle to get the CPI not to grow too much when the exchange rate's depreciating so much. So anyway, there's that. We get a fall in GDP, but unfortunately we couldn't get it to fall more. We could, actually, by playing around with elasticities of substitution and other things like that, but then the problem is we get killed on the CPI. So it's a real problem. Matching lots of impulse responses at the same time, you can match any one perfectly. But when you have a bunch of them, then it becomes a big problem. We got investment and the exports. We nailed the exports. Okay? And in fact, you should be shocked that we nailed the exports. I mean, if you forget for a minute that I've been using the word import, U.S. imports so much, you would be shocked about that. Here's a simple figure of thinking about what's going on with those impulse responses. You have a U.S. monetary contraction, so that's a Bauer-Swanson shock. It's a little bit of an abstract shock. It looks beautiful when you stand very far away, but I actually went into the kitchen, and so it's a kind of an abstract thing. But just think of it, some abstract thing that they do, the central bank, Fed does. And that has two consequences what has a lot of consequences in the United States, but it has two consequences that are of special significance to small open economies. One is simply that it raises the U.S. interest rate. The rise in the U.S. the interest rate is something that small open economies, all of them, AEs, EMEs, they have U.S. assets in their portfolios. So when the interest rate, therefore they can get the U.S. interest rate. So when the interest rate goes up, that's a very relevant thing for people living in these other economies. But these economies also involved in exports, and there's an export demand curve. They're small open economies, so they have an export demand curve. And that demand curve shifts with the movement in US GDP. So you can sort of think of this Bauer-Swanson shock from the perspective of the rest of the world, kind of launches two shocks at the rest of the world. There are two things that are happening in the rest of the world. And now here's where linearization is going to come in, and where I shouldn't have been so open yesterday when I responded to Ben, because we are modeling these other economies, we're linearizing them all. And I made a declaration that you're not supposed to do that in emerging markets. And, but anyway, we do that here, and that's an essential part of our analysis, actually. So we model all of those, the two types of foreign economies by doing a linear approximation. What that means is that when they're hit by, when the Bauer-Swanson shock hits them, we can literally decompose the interest rate effect, which is operating through the financial markets, and the import effect. We can literally think of the response of those economies as being literally the sum of the response to just that shock, part of the shock, and just that part of the shock. We have an exact linear decomposition because of the linearization. And, okay, so this is just saying what I just said. So now, in this graph, I can now show you kind of the linear decomposition. So if you go to the top left, that's the US dollar back again. So that's it's not the dollar, that's the interest rate, R star. I guess you can't see probably, I can't see them, so, well, that doesn't mean anything. So the blue line is the model's prediction about it's the model's impulse response function to the rise in the US dollar. And it reflects both shocks. It's got both shocks in it. That's the blue line. So you can see, for example, the very large fall in the exports in the blue line. Okay. Now there's another line up there. That's the red line. The red line is the one that operates if only the financial markets are involved. So what we call that is the pure interest rate effect model. Actually, maybe we stole this name from. There's a paper by Auclair, Rongley, and Straub. I think I've cited them now 3 times, but that's fair because there are 3 people. So Auclair, Rongley, and Straub, they're very clear in their paper. They're talking about what they call a pure interest rate shock. So the only thing involved is the financial markets, and they're totally upfront about it. Most people simply assume that the only thing that matters is the financial markets. So the red line is the response to what I called in the previous slide here, pure interest rate effect. That's the effect that goes just through the financial markets, and I set the import change to 0. And what you get is the the red line. Now, if you look at the red line, notice, oh, by the way, we have dollar pricing in here. We have the dominant currency paradigm in here, which is, so everything's priced in dollars. So dollar prices in trade are sticky in dollars in this model. Despite that, they still, they still do, the exports are still going up. So, we tried to get the exports not to go up, but they still go up. Actually, without the sticky in dollars, they would go up a lot more. But there ain't any hint of a possibility that they could go down. You just cannot get exports going down if U.S. Interest rates go up. The imports go up. That's Mr. Mundell Fleming at work. And then you see the effects on GDP in the red line are relatively small. So from this decomposition, you can see that the imports is the whole ball game. The imports are without the imports, you get nothing. With the imports, you get something that looks a lot more like the actual data. Okay, so, all right, so this is a repeat here. US monetary tightening produces a small contraction in output and investment in the AEs and a bigger contraction in the EMEs. Notice that conclusion integrates all of our robustness stuff. The picture I showed you had that the EMEs were going down, a ton, and here I'm saying it, I think, in a way that's more consistent, integrates our robustness. Much of the recent analysis of monetary policy focuses purely on the effect of a rise in the interest rate. That's what I call here the pure interest rate channel, or just financial markets. And we've given that channel every possibility of working. We got balance sheet effects. The interest rate goes up. The pure interest rate channel creates a depreciation. Then all the foreigners who borrowed in dollars, they get crushed because of that. So we got all of that stuff in there to maximize the likelihood that the interest rate channel will dominate. So we have all those frictions, but the analysis that only looks at the interest rate channel, there's one big problem. It's like the canary in the coal mine, I guess. This big drop in exports in foreign countries is inexplicable if you're just focusing on financial markets. I think I have some more time, so maybe I can elaborate a little bit more on that, because I've written papers myself where rise in the US interest rate actually makes exports in foreign countries go down. And the way it works is, you could imagine, think about this, when the US raises interest rate, it creates a credit crunch in the United States, sort of. Well, then you might say, well, maybe it creates a credit crunch everywhere. So maybe exporters have to borrow. And in fact, I think we heard yesterday that exports borrow. So maybe exporters are having a hard time getting an access to credit. And so maybe what's happening is there's actually a reduction in the supply of exports to the United States. So that first graph I showed you that I quickly went through has the price index of US imports. That price index goes down a lot. You cannot explain that without the fall in US imports being a demand shock from the United States and not a supply shock from foreigners. There's a second thing I want to point out, which is the AEs and the advanced economies and the emerging market economies, their exports both fall by the same amount. Now, our sense is that the advanced economies are much less kind of financially constrained than the emerging market economies. So if you want to build a big story about how exports abroad experience a big crunch, you got two problems. One is the US price index for imports goes down, suggesting a reduction in the demand from the United States for imports. Second, both AE, advanced economies, and emerging market economies, their exports both go down and kind of by the same amount. And if you're going to build a model that had big financial frictions, you probably wouldn't put a lot of them into the AEs, but both of them are going down. Their exports are going down by the same amount, which is something you can understand if the demand for their exports goes down. So that's why we're really emphasizing this trade effect. We're bringing trade in. We think trade actually does belong in macro. So our analysis suggests the main channel is, I told you before, I'm repeating the title over and over again. So our analysis suggests the main channel by which U.S. monetary tightening affects the rest of the world is via its negative effect on U.S. imports. That's it.
So we have time for a few questions. Over there.
Gonzalez, ECB. So thanks for the presentation. Shocking results. I guess slide 24 is a bit of the smoking gun where you show the difference between the blue line and the red line. I'm just wondering, on a technical level, did you also try to turn off? So what you do in order to get from the blue to the red line is you turn off trade. Did you also try to turn off financials just to see whether that really does make up the difference, or whether there might be some type of higher order interactions?
Well, yes and no. The picture, the blue line is literally the sum of the red line and the trade thing. So I could have showed you just the trade thing. The picture would have been, well, you would have gotten the same picture. Actually, with the trade, looks a lot like the blue line. But I'm hoping that you can kind of infer that from the fact that the blue line is literally the sum of it's an artifact of our linear. Well, it's partly an artifact of the linear property of VARs. But also, it's an artifact of the linearization that we do of the foreign economies. They add up, so there isn't any interaction effect at all. I think you maybe
that's what I would have thought.
Yeah, there isn't an interaction effect.
Okay, so then the policy conclusion that I'm taking a little bit from that is that in case that we have a more fractured world and the U.S. may be successful in importing less, does it mean that U.S. policy tightening is actually going to have less of an effect on the rest of the world going forward?
That would be the implication, yeah. I mean, if we went into autarky, well, it's hard to have autarky. Well, yeah, you could go into autarky and still have financial markets. So then, yeah, the effects would be, well, the effects would be like the red line. Yeah, if we go to autarky, the effects would be the red line. And Mundell Fleming would rise from their graves and say, I told you so.
Ben?
Thanks. Very interesting. So I had a very basic question, which is, I guess there's a difference across countries, how integrated they are with the U.S., in particular, how much the U.S. imports from these countries. I guess that's how your president comes up with these formulas, why some countries pay 150% tariffs and others pay 20%. So can you use that somehow to test your mechanism or look at your channel? Because I guess you'd think that if they're more integrated, this should be more important.
Yeah, so we've thought about looking at bilateral trade, and the problem is that I think bilateral trade is, we're now going into networks, and because I think bilateral trade in principle could be super misleading. For example, we might not really trade bilaterally with Colombia, but we do trade with Mexico. But we'll suppose that we buy stuff from Mexico, bicycles, and most of the bicycle is made in Colombia. Well, then in fact, we're trading with Colombia. So just looking at, we didn't look at the bilateral because we have a little bit of it doesn't feel good. But I would like to find, you can use Leontief inverses to figure out who you're really trading with. And we're sort of groping in that direction at this time. So, yeah.
Yeah.
Thank you so much, Ilya Lingorski, Bulgarian National Bank. How is this framework further developing with tariffs on top of monetary policy, creating shocking imports?
We're carrying this, and I had hoped to do this presentation about this subject here, but so we're not quite ready for that. But yeah, we're doing the following. We're now building a general equilibrium model of the whole world, and then asking one of the things. Well, first of all, we're going to ask: is this a plausible model? Then we have to check. Partly, is it consistent with the stuff we find, like the big drop in it? That's going to help us guide the parameterization of the model, is making sure that we get the response to a U.S. monetary shock right in the global general equilibrium model. But then the model will be used for tariffs, because there's almost anything can happen with tariffs. For example, nothing might happen. So in the extreme case where the reason for the trade deficit is that foreigners want US dollars to do transactions, in that extreme case, then it's necessary for the rest of the world to run a trade deficit with the United States. You know, how do you get dollars? Well, you have to sell potatoes to Americans. So in a world like that, the trade deficit is not a function of the tariff. A change in the tariff doesn't affect the trade deficit at all. You can show that in Ariel. So we've done this in an Ariel Rubinstein model with limit of only 3 variables: domestic, foreign, and in terms of trade. So there's so many possibilities about what will happen with tariffs that, as I said yesterday, the simple question, I raised tariffs, what will happen? There's an infinite number of reasons why. Well, first of all, nothing could happen, like I just said, or something would happen. We could have a recession in the U.S. We could have a boom in the U.S. There are all kinds of channels, and we're working through those. We're developing a model that allows us to think about all those channels. So
we have time for another question.
Sometimes I'm afraid that I talk too much, so people might hesitate to ask a question because there'll be an avalanche of words that will be thrown at them.
Yeah.
Okay.
No, thanks, fascinating talk. I was thinking whether from the perspective of the rest of the world, something similar might happen with China. So, because you're actually trying to kill the exorbitant privilege in a way of US, so the international role of the dollar would be something that plays, but is not a dominant factor is in your analysis. And
sorry. No, I didn't understand that. I just said now that if the world uses the dollar as a transactions medium, then we can run a trade deficit forever and not pay any interest on it, which is kind of what's happened in the last 40 years. So, and I haven't said any, and I agree that if the United States turns into a predator and takes over Greenland and Canada and then starts eating Panama and so on, then the US dollar may or may not actually retain its dominance. Because the only reason why people like the dollar is that they can get out of dollars quick. If they want to get out of their New York deposits, they can do that. And they want the dollar to be stable. And I don't think anybody cares whether from the point of view of the dollar as a transactions medium, I don't know that anybody cares about. So I haven't said anything about dominant currency.
No, exactly. But I mean, that's the point. What I'm saying is that from our perspective of getting the negative export, so whether you can, if you replicate this analysis for China, would it be different? Would there be any difference?
Yeah, that's a very good question. I mean, I think it would be interesting to replicate the results for the euro area, because the euro area is, or the European Union, or whatever, the euro area is gigantic. I think it's bigger than the US. And so now that also has the euro is also important for transactions purposes, but not as important as the US. So it would be interesting to do the same kind of analysis on the euro area. How does a monetary shock from the ECB, how does it travel to other countries? And actually, maybe that has already been done here. I know that people are looking at monetary shocks at the ECB, but the question is, how do they affect the other countries, and is it going through an import channel? That had nothing to do with the dominant currency issue.
But the EU and the euro area is a net exporter constantly when the dollar economy is a net importer.
No, okay.
Importer of last resort, is the US. When here,
there's a lot more
economic
stuff.
activities.
Yeah, I mean, the US dollar being, the fact that we're running deficits is not 100% because of the dollar being an important. I mean, you could imagine the U.S. running surpluses too. Absolutely. However, running deficits for 40 years and net interest payments from abroad remaining positive, they're still positive, they're getting a little bit smaller, but the net interest from abroad remaining positive, that's strongly suggestive of a transactions function, or it's a non-pecuniary, I should say, a non-pecuniary utility from dollars abroad. But actually, that would be maybe I should take back something I said. This taste for risk, which we assigned, which we said implies that you want to go into dollars. I don't know if that remains true today, but that thing may be not as important in the euro area. So maybe, but I don't think, anyway, it would be very interesting to see if imports are important in the channel.